markets haven't reacted much to earnings despite a lot of bottom line beats. How come?
Well, I would actually take it the other way, and I would say that markets haven't reacted to, I think, revenue pressures. They haven't reacted much to anything. I think, look, I think.
Well, there's the why. Why not?
Well, it's interesting.
That's why I did that piece earlier on market liquidity and volume.
I agree, and I think, look, I think they're looking to the Fed next week, and I think the consensus among market participants is that the Fed is going to save the day once again. You know, our view has been pretty consistent that another Fed rate cut is not going to matter this late in the cycle. Typically, late cycle cuts, and I don't think it's a mid-cycle cut. I think it's a late cycle cut. Typically, they're followed by economic slowdowns. Now, how quickly that manifests is obviously open to question, and I don't think markets are pricing it in.
Can they prevent a late cycle slowdown, Peter? Isn't that the point?
I think that they can't at this point, and here's the reason why I don't think so. There's just not enough room. Typically, the Fed has to cut around 5 to 7% in order to prevent or at least pull us out of a recession when there is a recession. We only have 175 basis points from here. We only had 250 from when they had just started cutting. And I just don't think that's going to be enough short of something more aggressive, which I don't think is.
Okay, so the headline so far is Cecchini says Fed can't and won't save the day. Does the day need to be saved? Are things that shaky right now in the underlying economy and maybe the markets?
Well, I think what you have to get the signals from is the second derivative of change. And we saw that second derivative of change, the deceleration of global growth, as early as last year, mid-year. We're starting to see it here in the U.S., mostly through investment and CapEx. And, you know, we saw very weak CapEx numbers in the most recent print this week. We're seeing ISM roll over in manufacturing. So the question is, does it feed through to the consumer? And it hasn't yet.
Not yet. Will it? Because the question I have, Peter, is why then are the markets near all-time highs? We're only 1% off on the S&P 500.
You know, it's not unusual for it to play out this way. The consumer is always the last to go. Consumer will spend until the consumer no longer has access to credit. It's pretty much the rule.
And you think that's what's going to happen eventually? So it sounds like you're saying the stock market is overvalued.
Yeah, we don't think risk-reward to U.S. equities is very good. We like buying long duration, you know, with the 10-year with the 10-year at 177, we actually think rates, 10 years.
Bonds have had a good year, by the way, this year. Bonds used to be boring, now they're sexy, apparently.
I agree. They've had a great year. Look, we called for the curve inversion this year. It's not inverted right now, but we think as the slowdown globally and in the U.S. manifests, we see lower long rates.